All right, so let's look at some more examples of how we are going to present our receivables, and more specifically, how we are going to account for accounts which become uncollectible, and how we present that on the balance sheet using a couple of different methods. So let's go ahead and get started here. It says Jefferson uses the percent of sales method for estimating uncollectible expenses. Based on past history, 2% of credit sales are expected to be uncollectible. Sales for the current year are $5,555,000. Which of the following is correct? Okay. So I do want to point out one thing as I read this. It says that 2% of credit sales are expected to be uncollectible. And then it says sales for the current year are $5,550,000. Now, it doesn't actually say here that this figure is all credit sales, okay? But we don't have any indication that these are not. So we have some choices here. And if we look, and it says uncollectible accounts are estimated to be 55.5. Uncollectibles are estimated to be 111,000. Bad debt expense is estimated to be $5,550, and bad debt expense is estimated to be $11,100. Okay, so really all we have to do here is figure out what kind of math we need to do. And all we have to do here, on the assumption that this figure is the amount of credit sales, is we're going to plug that in to our calculator. And if we multiply by 0.02, we're going to come up with $111,000. So with that in mind, choices C and D are completely wrong for a variety of reasons. Choice A correctly addresses uncollectible accounts, but it looks to me like we've only multiplied by 1% here, so that's going to be an incorrect answer. That leaves choice B, uncollectible accounts are estimated to be $111,000. Okay. Again, we are making the assumption that all of these sales here that they're referencing are credit sales. All right. Next question right here. It says, a firm uses the percent of sales method for estimating uncollectible accounts. The current balance in the company's allowance for doubtful accounts is $4,300. Company estimates that annual credit sales for the next year will be 5.5 million. So see, they're telling us that they're credit sales here. So that's good. And that 1.5% of these will become uncollectible. Question, what is the correct balance for allowance for doubtful accounts after adjusting entries are made? Okay, so not a lot to this question. If anything else, we're going to find out that this is something that's fairly simple. Let's see if we can fit this in here. It says that we're using the percent of sales method. So all we have to do because of that is take our figure for credit sales. Let's see, 5,500,000, and we're going to multiply by 1.5%, which is our estimate. Do notice that it's 0.015, and that gives us $82,500. But I also want to remind you that we're talking about the percent of sales method. And we have to account for this 4,300 here. Well, the percent of sales method uses an income statement approach. So our focus is going to be to add this 82.5 to whatever is already in the allowance for doubtful accounts. In this case, it's 4,300. So because we're using the percent of sales method, we're going to add that 4,300 to the 82.5. And so when it asks us the question, it says, what is the correct balance for allowance for doubtful accounts? There it is, $86,800. All right, let's continue. Right here, it says an aging of a company's accounts receivable indicates the estimate of uncollectible receivables totals $7,900. So I want you to understand that when you see this word right here, aging, that is an indication that we are dealing, it's an allowance method, but it's an aging or an analysis of receivables method, which uses a balance sheet approach, the opposite of the question that we just worked on. Okay. So it says if the allowance for doubtful accounts has a credit balance or a $700 credit balance, the adjustment to record the bad debt expense for the period will require a, so it looks like they're wanting a journal entry here. What we're saying here when we're using this aging, this analysis approach, is that we want $7,900 to be our beginning balance on the balance sheet. Well, if we already have $700 on the balance sheet from a prior period, whatever the case may be, then we're not going to make a journal entry for this full $7,900. I'm going to go through this, even though I think you can do this in your head. We're going to subtract that $700 out of the $7,900, and that's going to give us $7,200. Okay, so let's think about this. What we're going to do is we're going to go ahead then we're going to set up our journal entry. This is going to be our debit right here, bad debt expense. And we're going to use $7,200 for both the debit and the credit. Okay, so this, bear with me. As I'm reading this, this is what I would expect, something like that, perhaps with better penmanship, for the correct answer. Okay, if this was the percent of sales method, well, our balance would be 8,600, and our journal entry here we would just go ahead and be 79 and 7,900. But that's not what we're dealing with. We're talking about an analysis method, so the answer changes. Okay, bear with me 1 second. I'm still here. Let's look at this last question, and I did catch an error in this. It says allowance for doubtful accounts has a debit balance of $600 at the end of the year before adjustment. An analysis of accounts in the customer's ledger indicates uncollectible receivables, let's see here, of 13,000. So this customers here should be plural possessive, because we're talking about all the customers. And then what we're going to do here says make the proper adjusting entry for bad debt expense. So what that we're trying to get at here is we have to pay attention to a lot of stuff. First of all, we've got the word analysis here. That should indicate to us that we are dealing with an aging or analysis method and not the percentage or percent of sales method. The other thing I want you to notice is this $600 here is a debit balance. It is not the normal credit balance that you are used to seeing. Therefore, we want a $13,000 credit balance on the balance sheet, but currently we have a $600 debit balance. Okay, so what we're going to do is we're going to say in other words, we have written off when this happens right here, when we have this $600 debit balance, okay, what we've been doing is we've had a series of journal entries where we have debited allowance for doubtful accounts, and then we have credit accounts receivable. So we actually have $600 for bad debt expense that has never hit the income statement. So our journal entry is going to be bad debt expense. I'm going to abbreviate this in the interest of time. Bad debt expense and allowance for doubtful accounts. Okay, but not for the $13,000 that we want on the balance sheet, and certainly not for $12,400, which would be $13,000 minus the $600. This is what we would do if we had a credit balance. We're actually going to have an entry of $13,600. And the reason for that is because we have a debit balance. By doing this, we get the full amount of bad debt expense to hit the income statement as it should. Okay, that's it for this video.